Welcome back, trader. Mike here, reporting from Axia London HQ. And today we're going to cover how to layer classical charts, meaning candlestick charts, bar charts, excluding order flow, excluding price ladder, excluding the market profile. And we're going to talk about how you can take a standard set of classical charts using standard time frames like the 1 hour, the 30-minute, the 15-minute, and how you can layer all the way down to a microstructure like 15 seconds, 1 second, to give you a better understanding of how the market establishes these typical classic patterns. All right, so let's get into it. So as you can see here, folks, we've got a couple of classical charts, just a standard bar chart. Got a couple support and resistance lines here on the upper left. This is going to be a daily chart. This is just to have an idea of where we are on that long-term view. Not much else to say. Here is a main critical chart for us intraday traders. This is going to be your 1 second chart, right? So this large move that you're seeing here is actually the sort of 13-minute mark, as you can see here. This is 4:13 into 17 seconds on the April 2nd Rose Garden event. So 13 minutes into the event, the market experiences a liquidation to the upside that brings us all the way from 570 to 750. Now, if you were there trading that, you know just how volatile that was, and you know just how fast that was. That's why it's critical to have the 1 second chart, or at least like a 15-second chart, to give you a better understanding of how, say, the 3-minute or the 5-minute or the 15-minute, some of these more common sort of chart time frames are establishing, right? So I'm going to go ahead and press play. And for anybody that has kind of, been considering what happened on that day, let's just remind ourselves what was announced on that day, right? You had a baseline tariff of 10% applying to all countries with higher reciprocal rates on any country that doesn't essentially back off of their tariffs. That we knew. Canada and Mexico are exempt, which was kind of a bit of a surprise considering the fact that those two were the most focused on, given the USMCA deal. And then the sector-specific announcement with automobiles being tariffed at 25% starting on the 3rd, the following day after, with steel and aluminum at 25% ongoing, and Venezuelan oil-related imports at 25%, of course, related to the factor of geopolitical elements there, with Venezuela being a adversarial entity, if you will. Now, just another reminder here as we watch the distribution high here of this move, we can all see here the list that was announced. And the biggest one, folks, if I can just get this back here, the biggest one, folks, that's of significance, as we all know, is that China 34% tariff, right? Obviously, the 10% on some of these smaller countries is significant, but really this China 34% tariff alongside this, 47% Madagascar, 49% Cambodia, this is where we saw the market react as you are seeing now in the chart. So I'll move this and you'll be able to see very clearly now that after the market has hit this distribution high, it is now starting to break back towards that first sort of breaking point of the high above let's call it 735 on the handle basis. And the market is reverting to mean, or in other words, as many of you know, we call it an Axia, the scene of the crime. Now, here's the important part about this. This template where you're seeing a daily, a 1 second, 3-minute, 5-minute, 15-minute, 30-minute, 9-hour. That's just another version of the daily. For those that have watched my streams, 1 9-hour candle is one whole European session, or one whole US session, or one whole Asia session. So every day you get 3 9-hour candles representing that first Asia session, Euro session, and US session. So it helps me understand what the day looked like within increment of sessions rather than just one daily bar. So what is important here is to consider the fact that this template will effectively be usable on any volatility event. And that is, again, because you are breaking down the time frame view in such a way where you can correlate and bridge patterns that you are going to see in a CPI release, in a Fed release, in a ECB release, depending on which market. So it's critical that you have this classical view to be able to understand what these patterns look like. So you can not only take videos like these to rewatch them when you're relaxed, when you've, had a go and you want to look at how you performed and how that pattern has bridged with other 1 second or 3 minute or 5 minute bars that you've looked at before. And you want to be able to put that in your log so that, again, you can review, you can understand that this is, again, a phenomenon that you're going to see in many volatility events. And you can use it at your benefit when you are getting that pattern protocol and that system-based action that we talk about all the time with books like Thinking Fast and Slow, with the separation of those two systems. What's really important to also consider is the fact that this move here is giving a lot of substance, not just on this classical chart, but as you know, you've watched some of the order flow videos we do. There's going to be a lot of information as to why the market is moving to this excess liquidity point and through the liquidity that's established on that impulse move higher, right? So folks, as you can see now, it's being implied very clearly through the distribution of this high that the market wants to retest that scene of the crime. And notice that we have moving averages here on each time frame. So just a really easy tip, folks, just totally classical, not complicated. Go ahead and slap a 9-period weighted moving average on your intraday bars. And what you'll notice is that when there's a standard deviation of plus, say, 2 or 3 above these moving averages on a very small weighted average time frame, you're going to notice that the market, more often than not, when it trades a bar above that moving average, like I said, at a +2 or a +3, there is a reversion likely due, right? Now, if you have a market that's going to continue, you want to see those moving averages hold. And, you might come up with a pattern like, all right, when a market breaks out, I want to see it hold that 15-minute time frame before I go ahead and buy, right? Or in this case, when you have a volatility event that has the potential to release negative news that will move the market lower, you want to see that 15-minute get reverted to as a potential target. And then you want to see if that is now acting as a resistance on any rotation up. Now, remember, you can layer that with any indications that you're getting on your order flow. Let's say you're looking at the volume profile on your ladder and you see a little pocket right by the 15-minute and you know that the market wants to retrace back down. You can layer that and bridge that to add that conviction that you need. Again, a very holistic pattern. So as you can see here, we're approaching the 430 mark, and I'm just going to fast forward a little bit. You can see there's a lot of distribution, but one thing that is noted is that this low here is going to be a critical observation point for your footprint to see where the buy-in balance has developed, so that when the market, if it does retrace that unwillingness to buy, if those bids start getting hit, then you look to your order flow ladder to see the pace. And then when you see the pace, you can get more conviction that you're going to come back to that scene of the crime. So again, showing you guys how to use these classical views to layer them with those more sophisticated tools like footprint, market profile, and order flow. Now, I just want to go ahead and fast forward a little bit here to the point of the China 34%. So this is this point right here where the Trump tariff board comes onto the TV screen, and you can see very clearly the extension of this move is significantly larger than any of the moves that we see past this high here, right? The length here is, 8 handles, 9 handles, 15 handles. So that's when you know that pace is picking up, and you know that you can rely on the accumulative volume that is holding this ceiling to act as a point of interest for you to stay in the trade. Meaning, as long as you don't see this start to accelerate the way you did here with another leg higher, you want to look for that slow paced weakness. You want to look for that slow paced attack at those previous attempted buys that happened here and here, right? Because everyone's looking at this and going, oh no, I need to buy it, or I need to liquidate because I'm short. So you look to attack that, and you look for a certain pace that is different from the pace that you had here, which was a clear panic and rush to buy the market. So once again, as you can see right there, that's when the market really digests what it's reading. Again, just pulling this up here, you can see China 34%, EU 20%, which was anticipated, Vietnam 32%. That's when it all digests and there's a very, very clear response where, again, the scene of the crime is then taken out. You get a chance now, if you're in this, to maybe take a small bit of profit in case there is going to be a pause. But clearly, once you start to see that pace, you do want to see this all the way through. And for those that have watched many of our streams recently in the blueprint, Richard explained exactly what our traders did to access this move with their tactics and strategies using tools like this, tools like the order flow, like we've done in many of these videos. Now, lastly, I just want to show you the moving averages that I have here. This purple one here is actually just a 333-day moving average. Now, the reason I'm choosing that on the 1 second is it basically, I'm not going to do the calculation in my head right now, but it basically plays out to about 90 days on a chart like this one, for example, where you have this orange line that is representing about 77 days. Little tip for you all, 77 days is the moving average for the institutions. So again, folks, 2 moving averages here, a little bit longer one, obviously the 90-day, 333-day, if you will. And then this one here is just a very standard 10 period to help understand when you should be scaling in, when you should be scaling out, and when maybe you should wait for a full reversion back to kind of the center point of value on the basis of a microstructure, right? The way you analyze averages and potential reversions always depends on how you layer the time frame that you're looking at. I'm just going to go ahead and fast forward this a little bit so you can see how the next leg lower happens. So you can see there, like I said, when the market fails to retrace back to its original moving average, its most kind of obvious point of its so-called mean, this leg here is where you're definitely going to want to review your order flow, because this pullback here, you could tell there's a lot more liquidity trying to participate here, which is why the zig and the zag is sort of more erratic, spread out within that small time frame. Whereas this one was, although erratic, it was very swift and quick. And this one here, you could tell it's like buy, sell, buy, sell, buy, sell, buy, sell, then extension, buy, sell, buy, sell, buy, sell, then extension. Whereas here, you have just a lot more of like okay, rejected low, and then very, very minimal compression, and then extension lower. Then the second leg, a lot more chop, a lot more uncertainty, a lot more kind of almost panic within the market, with liquidity just trying to find its place. So these are little nuances that you want to notice and you want to review when you're watching back these volatile events to give you better pattern recall when you're seeing it in the heat of the moment next time, so that you can be calm, collected, and execute appropriately.